Okay, welcome back to the next session in our series, and we're going to be discussing what is EBITDA. You've got Dr. Mick Kling and Jay Binklitz here. So what we're going to be covering is how to define and identify our EBITDA, sample EBITDA calculation that we can talk through, and understanding why EBITDA is important to you as we move down our journeys, whether it's 1 year, 3 year, 5 years, or 20 years, why you need to know about it today. I think first and foremost, we need to think about what is EBITDA, and we'll get into the acronym of it, but ultimately EBITDA is a measure of a company's overall financial performance, right, Mick? You refer to it as enterprise value, is that correct?
Yeah, a lot of times companies will get compared to other investments. So if you are an investor and you're looking at two different businesses, you want some way to be able to compare those two entities against one another, removing as many variables as you possibly can to really understand the performance of the company. And so what EBITDA does is gives you a way to strip out some of the variable expenses that might influence the earnings of the business and just really give you a much better indication of the overall performance of the business so that you can use that information to compare to another investment opportunity, for example.
Right, and that's a great example. And ultimately, it is about measuring what we call free cash flow, right? At the end of the day, what is the cash flow of the actual business when we standardize and normalize certain factors in order to judge apples to apples? So first, let's discuss the acronym. I know we brought this up a little bit earlier, but it's earnings before interest, taxes, depreciation, and amortization. So it's your net income, the earnings that we discussed from sessions with Mick on his P&L, but we're looking at that number before interest, taxes, depreciation, amortization. In other words, we're going to add those items back, right, Mick?
Yeah, that's right. And think about $2 million practices, and let's say one of them has no debt at all, and let's say the other one has, $100,000 worth of debt, and they've maybe paid back $20,000 in interest. So now we've got these $2 million practices. One has $20,000 of deduction, interest expenses, and one doesn't. Well, it might make those two companies look different. In fact, the one that has the debt might actually seem more profitable because they have an expense, but that may not exactly be true. So removing the interest from the equation of calculating the value of this business is one clarifying point. The same with taxes. Your CPA might take, a depreciation on a piece of equipment, take Section 179, for instance, and take the entire depreciation all at once. And so they have a large deduction against the income of the business. And so your tax liability will be much lower. Whereas the CPA on the other practice might not do that, might do what's called a straight line depreciation. And so it makes the tax liability different. Again, so we want to remove
that's
the
huge.
tax
So
burden.
the philosophies by which you're submitting your taxes and how that's being done is going to play a factor. Also, depreciation. If one practice is a little older, one's a little younger, the older one might have depreciated all their equipment already. The younger one's still involved in depreciating their equipment. So these factors really play havoc on the numbers, which is why it goes back to the beginning of the term EBITDA, earnings before, right? And that kind of makes the playing field the same for everybody, right?
Yeah, Jay, I always like to tell folks that what your CPA is doing is simply providing an opinion. And we don't think about our CPAs, we think about just hard numbers. Just do the math, tell me what I owe in taxes. If we gave your business financials to 5 CPAs, we'd probably come up with 5 different tax liabilities. And you think, well, how can that be? And it's because some are more or less aggressive than others. Some might take, we talked about the differences between Section 179 and straight line depreciation. All those things will impact the tax liability of the business. And so just remember, your CPA is really providing an opinion and not so much hard facts. So it's removing that and their decisions and their recommendations about how the depreciation and amortization are treated. So our point in all this is we want to look at earnings before we let the interest impact us and we let our CPAs do all their hocus pocus to get us to pay less in taxes.
Makes sense. Makes sense. And I have to say, personally, before 2015, EBITDA really wasn't a word in my language. It took me a few months just to decide how I want to pronounce it, let alone to be able to explain it. Now to be sitting here with you teaching it, so it is something that I regret, that I wish folks had taught me many many years ago to think about in all the businesses I've been involved with, and it would have made a difference on my decision making. And I think that leads us into why EBIT is so important, because it really will ultimately impact many of the decisions that we make. As an example of EBITDA here, we're looking at the same $1 million practice we looked at in our earlier sessions, and we're subtracting our cost of goods like you talked about. We have $300,000 in cost of goods. We have a gross income of 700,000. So very clean lines here to think about it. I love your 4 buckets and your categories. So you have cost of goods, you have people, you have places and things. I mean, this is just wonderful language to make it really understandable. So here's our people, places, and things expenses. And then we come to our net operating income of 280,000. And then also, much to what you spoke about before, as we talk about doctor compensation, right? So we put that below the income line here, right? So we're seeing how the business is doing it by itself. Now we're incorporating our doctor compensation. That's our W-2 doctor owner compensation or associate, which gives us a final net income here of $155,000. So I think there's a really clean way. Would you make any suggestions on changing this in any way?
No, I like this. In fact, this is how we do it. The other thing I would point out, in the last session, we talked about the optometric net. And I think this is really clarifies why putting the doctor compensation below the net operating income really clarifies the optometric net, because we can see here that $280,000 essentially, helps us clarify that number as a percentage.
Yeah, agreed. Very clear. And then as we continue, we take the $155,000 net that we have, and now we're going to discuss Addbacks, and we're going to go a little bit deeper. We're going to do a little session on Addbacks to explain it. For the moment, let's just say there's a category called Addbacks here. I'm going to define Addbacks for the moment as discretionary expenses, and we're going to leave that on the side for a second. But those get added back to our net income, which increases our EBITDA to 205,000. We have a salary adjustment, and Mick and I are going to explain a little bit more about why there are salary adjustments and why there's rent adjustments involved in getting to what will ultimately become what we refer to as your final adjusted EBITDA. And that is the goal. Your goal is to be able to track your numbers. In an ideal world, it'd be wonderful to say that you're tracking this final adjusted EBITDA number on a monthly basis. But even if you're just tracking it on a quarterly basis, I think what you're going to find, and Mick, please jump in here as you see, I think you're going to find that you're going to be making different types of decisions when you ask yourself, how does this impact my final adjusted EBITDA?
Yeah, and I think, and we'll get into this in a little bit more detail, but I think it's important to understand the things like how you're compensating yourself. And if you own your own real estate, let's say you own the building that you're in, your CPA might be recommending certain strategies about how you pay yourself rent for that property. And all those things will impact the EBITDA calculation. And what we're trying to do is make adjustments for all those things, just like we did in the definition of EBITDA. We want to be as accurate as we possibly can and make all the adjustments necessary to really start to understand what is the true cash flow of this business when I take out all of the little twists and turns that we build into this, and our CPAs build into this as we really, quite frankly, just try to reduce our tax liability. So it gives us a much clearer picture as we get this so-called final adjusted EBITDA number.
Yeah, and going back to what you said before about the accountant, and this isn't pick on your accountant day, by the way. This is just, being very practical and understanding what the expectations are of these relationships, these professional relationships we have. Your accountant's job is to minimize your tax liability, right? So they need X information to do that. Your job is to run and grow and build your business. You need other types of information to do that. And it's just that simple.
Yeah, I love that. And our CPAs, just like you said, we really hire them to do two things. One is to file our tax return, and two is to make sure we pay as little in taxes as possible. Well, if you know what the GAAP formula is, the most basic GAAP formula says sales minus expenses equals profit. Well, the only way that you're going to get out of paying taxes is if you don't have a profit. So our CPA's objective of us paying no taxes is a complete odds of our objective of having a profitable company. And one of my favorite metrics is the more taxes that you pay, the more profitable you are as a company. And we think about a high tax burden as a negative thing, but often companies that pay a lot of taxes are also very profitable companies.
Yeah, it's kind of an odd place to sit. It's a place you could be proud and a place that could scare you.
Yeah.
So as we continue forward in our next session, we're going to go a little bit deeper into add backs and adjustments. We're going to look at what is an add back, how much is an add back worth, why add backs are a part of our EBITDA calculation, and all add backs are not created equal. And Mick and I are going to talk as well about on salary and fair market value for our rent. So looking forward to the next session.